Most people think buying a home is always the best investment, but is that really true? In this video, we will using financial modeling and Excel analysis to compare buying versus renting a property. We will calculate EMIs, create a loan amortization schedules, analyze future property value, and see which option creates better long-term wealth. Hi, I am Sabyasachi Nayak, and let's dive
This
into the
example.
numbers.
So we are assuming a property worth, that is the price is 25 lakh. Here we will put 25 lakh. Yeah. Then um, then down payment is 20%. Yeah, put 20% here. Then registration and other cost is 7%. Here put 7%. Then annual property appreciation, it's about 6%. Let's put here 6%. And the holding periods is 10. Let's put 10 here. Then here we have three details. First is property details, B is home loan details, C is rental details. Here we will calculate this and then we will compare which is the best, because we are this is the rental estate financial model, so that's why we need to property details, like we will invest in 25 lakhs next 20 years, so like that we can do. So here for home loans, interest rate is 8.5%. Let's put here 8.5. And tenure is about, I mean, how many years to you give, I mean, borrow the loan. That is 20. If we rent instead, the current rate is about 15,000. I mean, this is the current monthly rent. Like if we rent a house, what is the this is the average value. Like this is the average value. This is the 15,000. Then annual rent increase, that is 5%. Let's here put 5%. And 5%, this is yearly, right? Annual rent increase. And that a rental yield for ROI, I mean return on investment, that is, let's put here 3%. I mean year to year growth rate. This example is basically for tier 2 and tier 3 city. And in tier 1, the average rent is little bit high, like Mumbai and Bangalore. Then come to the investment alternative. If and one important assumption, if you don't buy, we invest in down payment at 12% annum. That is 12% annual return. So here we will put 12%. Yeah, all these type, every single number is this model is automatically. So here we calculate. Then the loan amount is 20 lakh. Then down payment is um, 5 lakh, and registration is cost is 1,75,000. Then total initial outflow uh, is about 6,75,000. Monthly EMIs, that is 70,356, and future property value, that is 44,077 lakh. sorry, 44 lakh 77,119. This is the future property value. Now let's go to the loan schedule sheet. This is the loan schedule sheet. The loan amount is 20 lakh. Here you can show the 20 lakh. That's property price minus down payment. To calculate the month EMIs, I use the Excel's PMT formula. So here the PMT is equal to calculate PMT is equal to rate by 12 tenure into 12 loan amount. This gives us a fixed monthly payment. Now every EMI has two parts, that is principal and interest. In early years, most of your EMIs is interest. As years pass, more goes to principal. This is called amortization. I used here PPMT for principal promotion and IPMT for interest promotion. Like here you can look at the year 1 versus year 10. When year 1 versus year 10, components drop significantly. You can see components drop significantly. This is very important for understanding the true cost of a home loan. So this is we can assume what are the value of a home loan. Next come to the part 3. I mean this is year wise projection. Now let's see here the year wise projection sheet. Yeah. So here is the property value growing at 6% every year to year. Okay. At year of 10, I mean year of 10, 25 lakh property become around 44 lakh. So in year 1 we saw here that is the 26 lakh 50,000. In year 10 we saw here 44 lakh 77,119. So this is the appreciation amount of that property. So in column, I mean in loan balance, it's showing the remaining loan balance. It reduces slowly in your early years. Okay, you also in year 1 here that is 19 lakh 60,115, but in year 10 you can saw 13 lakh 99,087. You can saw it little bit decrease, not little bit, and there is more decrease. So in equity column, also you can that's the property value minus loan balance. This is the equity, like that's the property value minus loan balance. This is your actual wealth being built. Like here we can saw the year 1 the equity value is 6,89,805, but in year 10 we saw that's value is 30,77,243. It's huge difference. I mean huge appreciation that amount. And this showing cumulative EMI paid by year 10, you have paid around 36 lakh total. Also in this cumulative rent paid, this is the cumulative EMI paid, and this is the cumulative rent paid. So in cumulative rent paid, around 23 lakhs over last 10 years. And here in investment value, uh, that is in if renting that house. So if you had invested the down payment at 12%, it would grow to 15.5 lakhs. Here we can see the 15.5 lakhs after 10 years. So renting saves money monthly, but investing wisely matters too. Next come to the buy versus rent financial comparison. This is the most important sheet. Um, Initial outflow, buying needs 6.75 lakhs. Here we can show the initial outflow is 6.70 lakh. That is upfront, and renting needs just 30,000 deposit. Monthly outflow is up to 1 years. That's net EMI of 17,356, and renting is about 15,000. In this is very cheaper, and total paid overs for 10 years. Like this is the paid over holding. Buying cost is more overall, but future property value is 44. Here we can say 44 lakh 77,179. But in rent, that is zero. In investment value, if renting, down payment grows 15.50 15 lakh 52,009. I mean, this is about 15 lakh point 5. And but in if you buy a home, that is become zero. Net worth impact, I can change the appreciation rate from 6 to 3%, and the verdict changes. Renting become the better. That's the power of financial modeling. It shows how you break even point also. And the ROI also you can see this is 563.3% and this is 210%. So my final verdict is about 14 lakh 52,601 is the net worth. And here we can see in graph also. See here the total amount paid over holding period, and this is the future property value. So here the final answer is buy or rent. There is no one size first of all answer. It depends upon property appreciation in your city, your loan interest rate, how long you plan to stay, what you do with the money if you rent. That exactly why we build the financial model, not to guess but to calculate. In cities like Mumbai or Bangalore, where appreciation is high, buying often wins. In smaller cities with slow appreciation, renting and investing may be smarter. The model I showed today cover loans, EMI, interest calculation, ROI, and future property values. All the key components of rental estate financial modeling. I hope this video helped you understand how you use Excel for rental financial decisions, not just theory. The Excel model I built today is full dynamic. Thank you for watching.